Hey, welcome to the 40 Finance channel, everybody. My name's Jeff Beers. Today we're going to do some thinking. We're going to think about the risk reward for buying stocks in this current environment, particularly the stocks that have been beaten down the most. I think it's fair to say if you're investing in the stock market that things have went down further than most people would have imagined, certainly further than I would have imagined. I sort of pegged the QQQ as having a potential to go down to 320 or so. That would have been about 20% off of its high. And here we are today, it's about $315. So the bears are obviously having a field day here in 2022, and it's not too hard to get steamrolled into that bearish sentiment, that bearish momentum. Everything just keeps going down. I believe we have a Fed meeting today, which has the potential to shake things up even more. We'll have to see how that goes. But if you want to think outside the box right now, I think you need to focus mostly on risk versus reward over the long term. So that's what we're going to do here today. We're going to pick out a few stocks that I'm familiar with, and talk about the risk reward. Like, where are these companies going? How far down is the bottom? And what realistically makes sense over the next 3 to 5 years? Now on this page, this is just a simple portfolio that I made here in Seeking Alpha. By the way, shout out to Seeking Alpha Premium. That's what I'm using here on the screen today. If you want to learn more, save a substantial amount of money, check out my affiliate link in the description. And these are the top holdings of the QQQ. But even just going through these names, right? All the names you guys are familiar with in the NASDAQ. And if we just hit this growth tab, and we want to see, like, hey, are these companies at risk of losing all their sales, potentially negative momentum, potentially further downturns to their EPS and sales numbers? Well, it doesn't take a genius to look at this, and this is revenue year over year and revenue projected forward, and you just go down this line, and while in some cases the forward revenue is less than the revenue year over year, there is not a single stock in here. In fact, now that I eyeball it, you have Intel, Cisco, and Pepsi, and T-Mobile as the only stocks that are even in single digits. And Intel is a very unique story. We talk about it all the time. You know, the promise in Intel from a risk reward standpoint is where they're going to be. So even though this number is basically flat, investing today with Intel combined with the dividend still has an opportunity to pay off big in 3 to 5 years. Now that's just the revenue side, right? What about profits for the QQQ components? Is anybody going to make more profits this year than they made last year? Well, I look at this column and I think it looks pretty good. You eyeball it going down, you've got 1, 2, this minus 12%, 3, 4. You have another 4 stocks that are still going to grow their EPS, right? Except for Intel. But they're just going to do it at single digits. Everybody else is growing their profits by double digits projected here in 2022. So I would say that the momentum, if you didn't look at stock price and you didn't look at a momentum chart, and you just looked at this table here, you would feel pretty good about a lot of the stocks that are in here. All right, let's flip over some individual names. Google, pretty good company, right? Down even more so today for no apparent reason other than a Fed meeting. And if we scroll down here in Seeking Alpha and we just look at our consensus estimates, right? What will Google do? What are they projected to do as they go through the year of 2022? You have an EPS estimate of 112. Now that comes in approximately flat from last year. And we know that Google has enjoyed some COVID benefits of people being on computers and such more. So is Google done growing, right? Is this flat EPS, if this even happens, is this flat EPS a sign of growth stalling and perhaps they go nowhere from here? Not at all. You look ahead to 2023, which is a fairly reasonable estimate, 133, that's 18%. And that's a forward PE of under 18. And when we think about this fiscal year, the 2023 fiscal year, we know that as the year goes on, once we get into that October, November kind of time frame, most folks will be using the 2023 projections as their most recent forward PE. So that'll be the denominator that they use in their valuation calculations. And even though October, November sounds, maybe that sounds far away to you, that's about 6 months. In fact, a little bit under 6 months, depending on how you look at it. Now let's look at revenue. How are things going on the top line for Google? Well, this year, almost $300 billion. That would be a double-digit increase over 2021. Got a price to sales of 5. A price to sales of 5 for a company growing double digits on the top line and double digits on the bottom line next year. So I think safe to say with Google at its current price, with a forward PE of 20 today, a forward PE of 20, I think the risk reward for this one looks pretty good. And not that it really matters, but you also have the stock split coming up in the summer. That could give a nice little boost to the stock from the standpoint of options traders, not having to hold as many shares to write their contracts. All right, let's take a look at Disney. This company has done pretty well over time, right? They have a lot of negative headlines lately for various reasons, for various political reasons. But we do know that Disney is one of the biggest brands in the world. We also know that travel, particularly consumer discretionary vacation type travel, is expected to boom this year. So September of 2022 is when this year's fiscal calendar ends. Got an EPS estimate of 443. Oh, by the way, plus 90% year over year. Obviously, the parks being closed and stuff hurt them last year. You got a 4P of 25. So are we all done then? Is that it? Are we going to grow at all going from there? Well, at least on these projections, you have 563 for 2023, which, by the way, everyone will be looking at effective October 1st. Then you got a 4P of 20. And you have plus 27% profit growth projected. How about revenue estimates? September 2022, this year, they'll grow revenues plus 25%, if not more. And you think about that for a second, even if Disney Plus takes like a Netflix-ish dive for some reason on new users, the parks are going to explode so much that I'm not even sure that it matters. It's just going to take a while for the market to get used to looking at the parks being what they used to be, which is basically a massive ATM machine for the company, right? Price to sales, under 3. Under 3 for Disney. And then you look ahead to next year, pretty close to $95 billion, another double-digit top-line grower. That would lower price to sales to 2.19. All right, I mentioned Netflix when I was talking about Disney. They're getting hit again, minus 3%. How about their business? How is it doing? Well, we know that there was some pull forward for COVID, and this year's EPS is actually projected to come in a little less, minus 2.3%. So that's likely why we're seeing this stationary bike going on with the stock. But if you look ahead to the future and you think about top and bottom line growth, Netflix has both. Okay, 2023, 1262, that's plus double digits, and that would be a forward PE under 16. All right, how about revenue? How's revenue doing? This year, not double digits, plus 9%, okay, but you got a price to sales under 3, and in 2023, plus 10%, double digits, and you get down to 2.5 on the price to sales. And don't forget with Netflix, There's an international component as well, so all this money does not have to come from the United States. All right, PayPal. This is one that has basically killed me here lately, but let's see what we have to be concerned of. Okay, December of 2022. This is a big update for PayPal. In their investor report or their earnings report, they did lower their guidance to 392, and that would be a minus 15% growth. Now, I'm very familiar with PayPal, and I can tell you that they probably screwed themselves because they took some write-downs and some investment gains last year that really made the numbers very murky. You also have the eBay transition, which is screwing things up. But nonetheless, dollar for dollar, this 392 is a minus 15%. Now you look ahead to 2023, getting closer to the $5 mark, plus 26%. That gives you a forward PE for 2023 below 20. How about sales, or revenue rather? December 2022, plus double digits, almost 12%. Next year, same thing, and pretty much projected at double digits for a long time coming. That puts your forward price of sales at 3.71. All right, next up I've got Lyft, and I picked Lyft out of a hat basically because it's getting destroyed today after they went to their earnings call where they said that they saw substantial increases in demand. They're getting hit because apparently they're giving a lot of bonuses and perks to drivers to keep their workforce strong. Wall Street does not like it when employees get some of their money, so that's what we're probably seeing here today. Let's take a look. This is a company, unlike Uber, that is projected to produce an EPS this year. Okay, granted, 61 cents, I get it, but we know that they're growing in the future. Today's forward PE would be 50. Now, next year, as the profitability starts to compound, in fact, triple digits likely at the bottom line, that forward PE drops to under 20. Okay, how about revenue? Let's make it easy. 32% growth, 25% growth in 2023, 20% growth in 2024. Price to sales today, 2.5. Now, what's the risk reward on Lyft, right? At $20.80. Okay, I get it. This company is not as established as the ones that we talked about prior, but the bottom line is everything looks to me anyway, that Lyft is going to make more money tomorrow than they're making today. And from a stock appreciation standpoint, particularly over 3 to 5 years, it seems like a pretty square deal when you think about risk reward. All right, we'll finish up with a wacky one here. This is one that I own, Magnite. And I believe my cost basis, I've gotten it down to, it might be $20, $22, something like that. But it's gotten absolutely destroyed. It's a CTV digital advertising play. And what's interesting about Magnite at $9.81, their EPS, which is projected to be positive this year, of 75 cents, not a ton of money, obviously, but it's something. It's not a stock that costs a lot of money, right? It's $9.81. So if they hit this number this year, 36% bottom line growth, $13.50. Next year, if they just get to $1, $10.09 on the forward PE. How about revenue? Just look at the growth numbers, plus 27% this year, plus 20% this year. It's a forward price of sales at 2.5. And what's interesting with Magnite, among other companies in the CTV space, is we're starting to see that industry really morph in front of us going forward, right? When you start thinking about ad-supported channels, that is right in Magnite's wheelhouse. So if I did get lucky as an investor, and let's just say that Netflix hired Magnite to manage its ad inventory, or frankly anyone like them, then these numbers would go up from here. So as far as I'm concerned, the risk reward for Magnite at $10 a share is pretty darn good, particularly if you can look outside of the year 2022 and just understand how that industry is changing and what Magnite represents. Okay, so the bleeding in the market has not stopped. It doesn't feel like it will stop, but it will at some point. We don't know when. I doubt the Fed meeting today is going to help anything, but we'll have to see how that goes. But I'll tell you, from my perspective, when you think about it very broadly in a risk-reward situation, there are plenty of big companies out there growing at the top and bottom line that make for a compelling risk-reward argument for your money. We know that putting it under your mattress during times of inflation is pretty much the dumbest thing you can do. We know that 0.03% or whatever they're giving you in your savings account is absurd, and that's not going to help you either. So at some point, the risk reward for the institutional investors is going to reach a point where they say, okay, we got to go, and they're just going to jump into the market. Hopefully, for people like me and people like you, we can snag some of these great risk-reward opportunities before the price goes back up. All right, guys, let me know if you're buying any stocks right now. I would love to hear about it. And don't forget to check out that Seeking Alpha special offer in the description. Hope everybody's doing well. We'll see you on the next video.